Thank you, Mr. Chairman, and it's good to see all of you gentlemen here. Thank you. I've enjoyed this discussion, and I certainly believe in market fundamentals myself, and certainly believe in making sure that market fundamentals are policed. But I can remember a time on this committee that we talked about what was wrong with electricity when Enron was manipulating the market, and there were a lot of people that thought it was 3,000 things other than manipulation until we proved that it was manipulation, and then everybody was like, oh, it's a manipulation. So I think the point here is, what is the functionality of the markets that we really want to see? And I was looking at your testimony, Mr. Yergin, about, Dr. Yergin, about the financialization of oil in the commodities market. And so I was curious as to your thoughts, on this. At what point does it really become a problem? Because it's quite clear the Commodities Exchange Act made it very clear that the commodities future market were created for two basic purposes. One, to provide a revenue for producers and consumers of physical commodities to hedge their risk, and two, to establish a fair price on supply and demand fundamentals. So we had Mr. Tillerson come before the Finance Committee a year ago now, and that was when oil was at $98 a barrel, and I asked him what should that price be. If he volunteered, if you're basing it on the next production price for a barrel of oil, it should be, he said, between $60 and $70. So it's clear that obviously and we know that this is the process and the cost of having both legitimate hedgers and speculators in the market, that there is obviously fear factor that's driving it up, there's financial risk. So, but my question is really about these institutional investors that make the commodities treated almost like an asset class like securities. And so these are people who are not in the market for any other reason than to make profit. They're not in the hedging for legitimate purposes or price discovery. They're there because it's a great financial play. And I'm curious as to at what price point or what percentage point do you think that becomes a problem? I don't mean the price of oil, but if Mr. Tillerson's right, and here's what he says the production cost is, and a lot of people think 15 to 20% is added on because fear factors, and then obviously there's all sorts of things that happen on any given day. But at what price do you think this asset class treatment of financialization really becomes a problem?
Well, I think that the financialization certainly has to do with what you're talking about, institutional investors or hedge funds who are in there regarding this as an asset class. I think it's a little, but when I use the term financialization, I meant something even broader, because you see, like CalPERS, the largest pension fund in the United States, regards commodities as an asset class, and a way you invest in commodities as a way to play economic growth in China and so forth. So it's not easy to separate it into the segments, and I understand that's the question you're asking. I think
No, I'm not even asking you to guess what it is. I'm just saying, at what point, if I said, okay, they're affecting the price by 50%, or they're affecting the price by 30%, or 30% of the above $60 to $70, which Mr. Tillerson says is the marginal cost for producing another barrel of oil. And so if that's what it is, and we know there's all sorts of these other factors, right, but at what point do you think the asset class investment changes the commodities market and becomes a problem? If it's affecting 30% of the price, if it affects 40% of the price, it affects 50%?
I don't know what the point is. I would say, by the way, the costs, even since he's testified, the cost of developing the marginal barrel have gone up somewhat, so that number would be raised somewhat. But I think, I guess you're asking not in terms of the current circumstances, but at what point.
Would you worry about it? Yeah.
I don't have an answer for that right now. I'm looking rather at the market and saying, based upon, as you said, supply and, the fundamentals are what's there, and there's a fear factor or a premium factor in it. But I don't know, do you have a number in mind? Or?
Well, I definitely believe that we should get these asset class investors out of this market. That's my personal opinion. When I look at Mr. Veracito's chart here, and I see this level of volatility at this end and this level of growth, I start asking myself, is it worth $50 a week more to a Washington consumer driving to allow a bunch of hedge fund investors to drive up this price when it hurts the U.S. economy? I think the answer is no, because commodities markets are about price and supply price and supply discovery. So they are to meet, that marketplace for legitimate hedgers. So saying that we are going to allow a bunch of investors to treat the commodities market like they want to treat the rest of Wall Street from a securities and investment perspective, I think is the wrong idea for commodities. Something particularly as vital as gasoline.
Right. No, I understand. The only thing I would kind of add is I think that that point about if those markets were to leave the United States and not be I'd rather see these markets in the United States regulated with the kind of scrutiny they have than occurring somewhere else where they're not under scrutiny. And so part of the issue is that it is a global marketplace.
Well, and I would add to that, because I'll bet you could get the Europeans and the Chinese and everybody else to add in, because I've heard from many of those people. They've been to my office. I think it's amazing that they come to my office, even elected people from Japan, saying, what can you do to get these investors out of the commodities market? Because they're feeling the pinch around the globe. Thank you, Mr. Chairman.